In 2009, India was rocked by one of the country's most notorious corporate scandals when Satyam Computer Services, once hailed as a shining example of India's IT industry, was engulfed in a massive accounting fraud. The scandal, which involved falsification of financial statements, inflated revenue figures, and fictitious assets, sent shockwaves through the Indian business community and raised serious questions about corporate governance and regulatory oversight in the country. Background of the scandal: Satyam Computer Services, founded by Ramalinga Raju in 1987, rose to prominence as one of India's leading IT outsourcing companies, serving clients worldwide. However, in 2009, Ramalinga Raju stunned the business world with a confession that he had been manipulating the company's financial records for years, inflating revenues and fabricating profits to the tune of billions of dollars. The revelation sent Satyam's stock price plummeting and triggered a crisis of confidence among investors, clients, and regulators. Accounting manipulations and falsified records: The Satyam scandal involved a web of fraudulent activities orchestrated by top executives, including Ramalinga Raju and his associates. The perpetrators inflated revenues through fictitious sales, inflated invoices, and sham contracts, creating the illusion of robust financial performance. They also fabricated cash balances, overstated assets, and understated liabilities to conceal the true financial position of the company and mislead investors and stakeholders. Culture of deception and collusion: The Satyam scandal exposed a culture of deception, collusion, and unchecked power within the company's leadership ranks. Ramalinga Raju and his associates wielded unchecked authority, bypassing internal controls, and manipulating financial data with impunity. The company's board of directors and external auditors failed to exercise proper oversight and due diligence, allowing the fraud to persist undetected for years. Regulatory failures and oversight lapses: The Satyam scandal shed light on significant failures in regulatory oversight and corporate governance in India. Regulators, including the Securities and Exchange Board of India, (SEBI), and the Institute of Chartered Accountants of India, (ICAI), came under scrutiny for their failure to detect and prevent the accounting irregularities at Satyam. The scandal prompted calls for reforms to strengthen regulatory oversight, enhance transparency, and promote accountability in India's corporate sector. Fallout and repercussions: The fallout from the Satyam scandal was profound, with the company's stock price crashing, clients deserting the firm, and thousands of employees left in limbo. Ramalinga Raju and several other executives were arrested and faced criminal charges for their role in the fraud. Satyam was eventually acquired by Tech Mahindra, and efforts were made to restore trust and rebuild the company's reputation under new leadership. Lessons learned: The Satyam scandal served as a wake-up call for India's corporate sector, highlighting the urgent need for stronger corporate governance standards, independent oversight, and whistleblower protection mechanisms. The scandal underscored the importance of transparency, integrity, and accountability in corporate reporting and governance, prompting reforms aimed at strengthening regulatory oversight and restoring investor confidence in India's capital markets.